Hi, this is Azad Ahmed, and again, now we're going to be discussing further about life insurance. This is for the LLQP exam prep in Canada. But however, it's still interesting to know about life insurance for anybody who has a life insurance policy or thinking about getting a life insurance policy. So these rules and regulations are based on Canadian laws and rules and regulations, but it still may be useful for your own country to understand these concepts. So we've already gone through chapters 1 to 6 in the previous videos. And so now we talk about chapter 7, which is the taxation of the UL policies. So with taxation, basically, if you have an exempt policy, by exempt policy, we mean that the policy holder has put in money below the maximum limit and the policy is in good situation based on the policy holder has been paying the premium regularly. It is an exempt policy. It is exempt from taxation. So every year, the holder of the policy does not have to do any taxes on the investment profit. And when the person dies for the UL policy, the death benefit is paid tax-free to the family, to the beneficiary, and the investment profit is tax-free. So those are two big benefits from the UL policy. When you have a universal life policy with an investment component, there could be $250,000 benefit, a death benefit, plus there could also be maybe $20, $30, $40, $50,000 investment portion in the policy. So that is all tax-free. The disposition is the concept. The government of Canada says that CRA, that if any of these things happen, then there is what is called a policy disposition. And disposition is like dispose, you throw away, you cancel. It's considered you have, finished off the policy, and then there may be taxes due. And we'll talk about these different scenarios in more detail in the next slides. Cancels a policy. If you cancel a life insurance policy, the government of Canada is going to say, tough luck, this policy was supposed to protect your family and you had money in it as an investment portion. Now, since you canceled the policy, they will calculate some taxes may be due based on the profit in the policy. If the policyholder surrenders all or part of the policy, that is, suppose a person has a policy for $250,000 and they say, I only need $200,000 now. I want to reduce my face amount. If they reduce that and they have investment in the policy, they may have to take money out of the investments because it is extra amount. There's a limit, there's a maximum limit how much you can put into a policy. And so because of that, then there may be some taxation due. If the policyholder withdraws cash from the investment account in the policy, then also there may be some taxes due because the government is going to say that because you took out the cash from the investment account, in this situation, now you need to pay taxes on it because this is not the intention of this UL policy. If the policyholder takes out a policy loan, there also may be taxes due. If you have $10,000 in your investment account and you say, give me a loan of $8,000, you may have to pay taxes on it. It depends on, of course, how much you put in and what the value is. We'll talk about that later. Participating policy pays out dividends. If you have a policy which pays dividends, like we mentioned in the whole life policies, then also there may be taxes. If the policy becomes non-exempt, that is the client, due to not knowing or knowingly puts in more money than allowed within the investment account because there's a maximum limit, then the policy becomes non-exempt. Meaning non-exempt means it is not exempt from taxation. Now it will be taxed. Policyholder absolutely signs or transfers the ownership of the policy to another party. So if the policyholder takes that the policy and says, I'm not going to be the owner anymore. Now someone else is going to be the owner. So you transfer the ownership. In that case, there will be some possible taxation due also. Or the policyholder dies and is not the life insured. So for example, if a person takes out a life insurance policy on their wife, okay, so if their spouse dies, the policyholder gets the money. That is a situation possible. And if that owner dies, now someone else needs to be the policy holder because this person died. Now the wife cannot be the policy holder. She's the annuitant. She's the person who needs to die in order for the money to be paid out. So in this case, then she could be the policy holder, but that is also possible. So it transferred to her or to someone else. And in that case, then there may be some taxation due. So in all these situations, if that happens, then there may be some taxes. If you don't do any of this stuff, you just pay your premium and the policy remains, below the maximum limit it is allowed to the investment account, then it's an exempt policy. Then you don't have to worry about anything extra. So in this chapter, we're going to talk about the concept of taxation of policies, but I just want to give you an example. Let's suppose you buy a home. You bought the home, the cost for your home was $200,000. That's the ACB. It's called the adjusted cost basis. The adjusted cost basis is a fancy word that the tax people use for saying what was the cost for you to buy that product, that item. Suppose you sell the home for $300,000. That's called the proceed of disposition. Disposition is cancel or dispose of. So you sold your home for $300,000. Obviously, the profit is the difference. That is $100,000 is the gain. It's called a capital gain for the home, but generally it is called a gain. So the same way the insurance company or government of Canada will calculate the policy gain. If you cancel a policy, simply you cancel the policy, they will say, okay, how much money did you get from canceling the policy minus how much money did you put in. So obviously, if the value is higher, if you have $20,000 in your investment account and you put in $5,000 only, you obviously have a policy gain of $15,000, which will be taxed. So this is the simple concept of the policy gain. So the adjusted cost basis means the cost basis for an insurance policy for tax purposes. Example from your book is that Brian surrendered his whole life policy, received $46,000, and the company told him that your ACB was $20,000. So he's got a policy gain of obviously the difference between these two, $26,000, and 100% of this is going to be taxable. So that is the policy gain. That is how we simply calculate it. Okay, so all these factors affect ACB. We're going to talk about these in a little more detail, but this is a good summary. And so we will talk, I'm going to come back to this, but this is an important table to remember in terms of calculating how much is what is the ACB. So let's take a look at this example here. You have a policy which is 10 years old. You've been paying into the policy for 10 years. It's a $100,000 policy. Let's suppose you paid premiums equal to $25,567. That's the money you've paid so far. The cash surrender value, that is the value if you cancel the policy, you will get $26,194. It's also known as the fair market value of the investment. That is the investment portion of your UL policy is this amount. That is, if you cancel your policy, this is your cash surrender value. Let's suppose the dividends paid were $5,000, which is a return of premium. So dividends paid by the company are considered to be a return of premium. That is, the premiums you paid are just given back to you. The net cost of pure insurance, that is the cost of insurance. That is what the insurance company has charged you for the insurance, is $9,470. So there's two calculations. One is before 1982 December and after 1982. Just think in your mind that after 1982, the government changed the rules and they obviously wanted more taxes. They increased the taxes due on the policies if you cancel the policy. So if you cancel a policy before 1982, first of all, we need to calculate what is the ACB. That is the cost of the policy for the tax purposes. To calculate the ACB, you have to take the premium minus the dividends. So the premium the person paid was $25,567. That is the monthly premium he's paid, or annual rather, cumulative, minus the $5,000, which is the dividend that was paid to the person. So $21,567 is the ACB in this case. Now the policy gain, remember here we talked about the policy gain. Simply the policy gain will be proceeds of disposition minus the ACB. So what we do is we take the 26,194, which this is the CSV that is from here, the 26,194 minus the 21,567, which we just calculated from here, and we will get 4,627. So that is the gain, or that is the profit that the person got. He got a check in the for canceling the policy. He got a check in the mail for $26,194. But for tax purposes, we need to think, what was his cost? His cost was $21,567, which we calculated here, and so there's a gain of $4,627. And in this case, so now in this case, this is the policy gain. Now, if the person is at a 35% marginal tax rate, that is, this person pays 35% taxes on all the profit, on all the income he gets in that year. So we have to calculate what is 35% of 4,627. And when you calculate that, that will give you this figure here, which is your calculation. So if I just do that quickly here, you can see that here. So so we said that here, 26,194 is our CSV, cash surrender value, minus the 21,567, and that gave us our 4,627 proceeds. The policy gain. So that policy gain, now this we take and we multiply it by 35%, and that's same as multiplying by 0.35, and the answer will be 1619 is the tax that he has to pay to the government. So he got a check in the mail for 26,194. He has to pay 1619 to the government on taxes when he does his tax filing. And obviously the after-tax money will be the difference between these two. In his pocket, he still gets 24,575. So in this way, same way, the second calculation for this in December 2nd, 1982, after that date, the government changed the rules. The only thing they added here was the NCPI. They said when you calculate the ACB, you do premium minus dividend, but now you also minus the NCPI. And the NCPI, net cost of pure insurance, in this case example, was 9,470. So when we minus this 25,567 minus the 5,000 minus this number, we get 12,097, right? That is the ACB that we are getting now, the adjusted cost basis, instead of this one. So it's saying now your cost actually was less. And if your cost is less, then your gain is going to be higher. So think that if you bought a house, for 100,000 or you bought it for 50,000, if you bought it for cheaper, then your gain is going to be higher, right? So this is the concept here. And basically here in the gain is going to be CSV minus ACB, which will be equal to now 14,097 is your gain now in this case after 1982. Now because you have a bigger gain, you have a bigger tax liability. So now if you cancel the policy after, if your policy was issued after this date and you cancel the policy, then your same case, in that case, and the person is the same 35% tax bracket, he would be paying $4,233 in taxes. And so obviously less money in their pocket. So this is the main difference between the before 1982 and after 1982 is the NCPI, which was added on to this calculation for the ACB. Now this concept is used in all the other cases also. So you just have to remember always, first you need to think, what did the client get in their pocket? What is the money they got? Minus ACB. Either they give you the ACB or you have to calculate the ACB. And the difference is your policy gain, and that is taxable at their marginal tax rate. So that is simply the way we are going to calculate this. And so in this case, we're talking about after 1982, the taxation for an exempt policy. That simply means it's an insurance policy with investment value which is less than the maximum allowable MTAR value. And so in this case, the growth or the profit in the policy is exempt from taxation. So the growth does not have to be taxed in this case because it's an exempt policy. A non-exempt policy definition means that it is an insurance policy where the amount in the investment value is higher than the maximum allowed. And so this policy is not going to be exempt from taxation. The growth, the profit is going to be taxed. MTAR is the maximum taxation actuarial reserve. That is the maximum allowed deposit to the UL policy. And basically, how do they calculate it? It's the cash value of a exempt test policy. They calculate that how much can 8 annual payments be deposited at a 3.5% interest to make it a paid up policy. So that is basically how they calculate MTAR. But just keep in mind that if cash value, that is the amount of the money in the investment account, is less than the MTAR, it's okay. If it's more, then you have a problem. It's not allowed. There's several remedies to do. Something has to be done. So either number one, increase the face amount, and the maximum they can increase is 8% annually. Or the client withdraws the premium, the extra premium, and tax will be due. It's considered as a partial surrender. Or the insurer moves the money, extra money, to a taxable side fund account. Usually it's this third case that they usually do that. But if they don't do any of these things, then tax is going to be payable on all the full policy gain. Whatever profit is there, all of it is going to be taxed. So something has to be done in this case. So the anti-dump rule says that you cannot, so it prevents the policyholder from making large lump sum deposits to the policy after its 7th year. So in the 10th year and every year afterwards, the cash value will be compared to the cash value in the 7th year. And this should not exceed 250%. So in this case, it should not be over this amount. Let's take a look at this example. So suppose Alicia pays $12,000 of her $19,000 loan. She'll be able to claim a tax deduction of $9,000, which is the policy gain. She had to include her income as a result of the loan. The ACV would increase to $3,000. So ACV, as we calculate, is simply $12,000 minus $9,000. So the the cash value in the 10th year in this example I was mentioning to you was $15,000. And let's suppose the cash value in the 7th year was 4,200. So what they do is they take a ratio. What is the ratio between this 15,600 and 4,200 times 100? That's a 371%. This is over and above the 250% limit. So the maximum allowed is 250%. So what is 250% of 4,200? That is 10,500. So 10,500 is how much he should have, but he's got 15,600. So the difference between the two, he has to take out 5,100. That is the rule for the 250%. Okay. So now before we go on to the next concepts about the taxation situations, just want to mention to you, these are different situations can happen if a person cancels their policy, reduces the coverage, takes out a loan, repays the policy loan, they withdraw the money from the cash value, the policyholder dies, right? Or any of these situations happen, there is a calculation for the policy gain and for the taxation. So we're going to go through these in the next video. I hope you are getting benefit from this, and we will continue our discussion in the next video. Have an excellent